If you're new to investing and you've got no idea where to start, then it may be a good idea to consider investing in ETFs. ETFs, which stand for electronic traded funds, are a basket of many different stocks that you can buy and sell in just one single tradable security. Let's say, for example, that you want to go to a party, but you don't know what to bring. So you go to the shops, instead of going down a shopping aisle and buying lots of different chocolates, sweets, and lollies, instead you decide that you're just going to buy a single box of favorites and you're just going to bring that to the party instead. The favorites box has all of these different chocolates, but you're just buying the favorites box in a single transaction. And it makes sense because you just want to buy one box of favorites, which consists of all of these different chocolates, as opposed to having to buy all of these different chocolates like individual Mars bars, dairy milks, and cherry ripes. And an ETF is just that. It's essentially just one stock similar to a box of favorites, which in turn allows you to own many different individual stocks, which in this case would be the chocolates inside the favorites box. Now that you know what an ETF is, you should also know as well that you can buy and sell ETFs as a single tradable stock on the Australian Stock Exchange. And buying this single stock means that you own many different types of stocks. And the collective value of all of these different stocks effectively determines the single share price of the ETF, causing the stock of the ETF to go up and down in value over time. Now, I'm not a financial advisor, but there are several advantages of buying ETFs as opposed to buying individual stocks. With ETFs, you can buy and sell the stock whenever the market is open. ETFs aren't necessarily a stock in and of themselves because they're made up of lots of different shares, but you do buy ETFs as if they are a single stock. The first advantage is that the performance of ETFs have been shown to be as good, if not better, than buying individual stocks. The second is that ETFs are a really good way for new investors who are just looking to begin investing in the stock market. Since they're made up of lots of different stocks, investing in ETFs is very low risk. Buying individual stocks also means you have to spend a lot of time researching and determining what stocks you are going to buy. It also means that if you buy individual stocks, you end up paying lots of money in brokerage fees. But with an ETF, you can own all of these stocks in a single brokerage fee because you're only buying one stock. And it also means that therefore you don't have to spend all this time trying to research what individual stocks are the best to buy. That being said, ETFs usually do have management fees. But if you can find an ETF that's got a really low management fee, then it's really then just a case of investing and setting and forgetting. And that's usually the case for ETFs that don't have active management for them. And that means they don't have professional fund investors actively choosing and switching stocks on an ongoing basis. They're simply ETFs which just passively track the overall stock market index. So that's why in today's video, I've chosen the top 5 best ETFs for beginner investors. And these, for the most part, are passive ETFs, meaning that there's no active fund manager actively choosing and swapping out individual stocks. This also means that their management fee is really low. The first ETF is the Blackrock iShares ASX 200 ETF. And the code for this ETF is IOZ. This ETF is a single tradable stock that provides you with exposure to the top 200 companies on the Australian Stock Exchange. This means that in a single trade, you will collectively own shares in some of the largest companies in Australia, including Commonwealth Bank, Westpac, BHP, and Woolworths. You can see here on the right-hand side how much of these individual company weightings form part of the overall ETF. So you can see, for example, that because CBA is the largest market capitalization company on the ASX, or in other words, the top company on the Australian Stock Exchange, it makes up the highest weighting of this particular ETF at around 8%. CSL makes up about 6% and Westpac makes up about 4%, and so on and so forth. The weighting of these individual shares for this particular ETF is just simply determined by their market capitalization, or in other words, how much each individual company is valued in relation to one another. So the primary purpose of this ETF is to provide investors with a broad exposure to the top Australian companies that are listed on the Australian Stock Exchange. Now, to understand what I mean by an index, what I mean is that an index is a representative sample of shares that make up the overall stock market. So therefore, the price of this ETF just simply follows this fixed index, which in turn is determined by the indexed price of the top 200 companies on the Australian Stock Exchange. So whenever one company drops out of the top 200 companies, it's simply replaced by the next company below in the queue. So rather than having to research, look up, and buy lots of different individual shares, and therefore have to also pay heaps of money in brokerage fees, the BlackRock ASX 200 ETF provides you with exposure to the top Australian companies in one single trade that you can look up and buy in CommSec or any other Australian brokerage platform. Now, BlackRock will charge you money as an investor because you're buying into one of their investment products, including their ETFs, and that's just because it's part of their business. Management fees for ETFs are standard practice. For this ETF, the management fee is 0.07% per year. What that means is that for every year in which you own this ETF, you have to pay BlackRock 0.07% of your investment value. The price that you pay to BlackRock every year will change depending on whether the value of that ETF goes up or down. If you invested $10,000 in this ETF, that means you would have to pay BlackRock $7 per year as a management fee. But if the ETF increases to $20,000 in value, then you would have to then pay BlackRock $14 per year in management fees. Importantly though, you're not actually having to pay any fees as part of owning this particular ETF. The fees are built into the price of the overall stock. What that means is that once you buy the share, you effectively own it like you do with any other shares. There's no ongoing fee that you have to pay to any company in order to continue to own those particular shares. But what I really love about this ETF is that you get paid dividends on a quarterly basis. And typically the dividends come out to about 3% on average per year every year. Also, since its inception, the ETF has delivered around 8 to 9% average annual return per year. That's assuming that you reinvest those dividends. This also takes into account the annual management fee that I raised earlier. So it's basically a net return, but you'd still have to pay taxes. 8 to 9% per year is certainly very solid, and it's certainly a lot higher than if you were to invest that money in a high interest savings account or government bonds. And even if you decided to not reinvest those dividends, getting 3% per year is still a lot higher than any other savings account currently in Australia. And as far as I could find, this ETF has one of the cheapest management fees in Australia as well. Now, if you still want to invest in the Australian stock market, but want to expand out your portfolio to even more companies that are listed on the Australian Stock Exchange, then another option to consider is the Vanguard Australian Shares Index ETF, or the VAS. Now, similar to BlackRock's IOZ, VAS actually tracks the top 300 companies on the Australian Stock Exchange. And since its inception, this ETF has delivered an average annual return of 9 to 10% per year, which is actually about 1% higher than BlackRock's ETF. But that being said, their management fee for this ETF is slightly higher at 0.1%. So again, if you invested $10,000 in this ETF, then you would be paying Vanguard $10 a year in management fees. But again, you're not actually paying Vanguard $10 a year as a management fee. That money is just built into the value of the stock. Whether you decide to buy BlackRock or Vanguard is completely up to you. But it is important to remember that past performance isn't indicative of future performance. Overall though, if you looked at say over the last 10 years or even since its inception, then you would be better off going with the Vanguard ETF, which again tracks the top 300 companies on the ASX, as opposed to the BlackRock ETF, which only tracks the top 200 companies on the ASX. Now, that being said, both Vanguard and BlackRock are huge companies, and this is a pretty conservative ETF. It's certainly very well diversified. And for me, I actually decided to go ahead and buy IOZ because I thought it was a great low risk investment. Those are the two main ETFs if you want to invest in the Australian stock market. If you want to buy US shares, then you can still buy ETFs on the Australian Stock Exchange. But these ETFs are made up of American stocks. These types of ETFs are becoming really popular in Australia because it means you can technically still invest in the US share market without having to fill out a whole bunch of paperwork. If you want to buy an ETF which tracks the S&P 500 though, then things do get a bit difficult to manage in Australia. There certainly aren't very many cheap ETFs that you can buy which track the S&P 500 on the Australian Stock Exchange. But the following ETFs I certainly think are a great alternative. There is firstly the BetaShares QUS ETF, which is an ETF that aims to track the overall S&P 500 but actually applies an equal weighting to each individual stock. What that means is that this ETF provides you with exposure to all of the companies that are listed on the S&P 500, but each of them are actually weighted equally. So it's not technically like if you were to invest in the S&P 500, because then technically the S&P 500 isn't actually weighted equally. It's instead largely made up of big tech companies, and that's because of their huge market capitalization. So for example, Apple actually makes up 6% of the S&P 500, and Microsoft also makes up around 6% as well. However, you aren't technically getting these weightings with the BetaShares QUS ETF. And because everything is individually weighted, each individual company only makes up around 0.3% of the total ETF value. Now, BetaShares argue on their website that by applying this equal weighting to all of these companies within this ETF, they've technically been able to outperform the S&P 500 because they're able to sell higher priced shares whilst also buying those which are lower price, resulting in them regularly rebalancing their portfolio. They also claim that by applying this equal weighting to all of the stocks within this ETF, they're actually reducing your investment risk because you're less reliant on these large tech companies, which make up a huge proportion of the S&P 500. But this rebalancing doesn't come cheap. Their management fee for this ETF is 0.29% per year. And that's basically 3 times the size of the Vanguard and BlackRock ETFs that I mentioned previously. Over the past 5 years though, this ETF has returned about 15% on average per year every year, which is 50% larger than the returns that you would get if you were to invest in the ASX 200 ETF. For me personally though, it wouldn't necessarily make sense to invest in an ETF which charges such a high management fee, simply because they're just redistributing the weightings of these individual shares in the portfolio. And just because this ETF has returned 15.5% per year over the last 5 years doesn't necessarily mean that you'll get that same return in the future. There's also no hedging against the US dollar either, which means that if the Australian dollar were to fall relative to the US dollar, this is going to impact the value of the ETF and your overall investment. So the next ETF to consider if you want to buy US stocks is the Vanguard Total US Market ETF, or VTS, which is available to buy on the ASX if you search up VTS. Now, VTS doesn't track the S&P 500 index. Instead, it actually tracks another index called the CRSP US Total Market Index. And this basically provides you with exposure to an extremely broad array of US stocks. This ETF is basically made up of 4,000 stocks on the US stock market. And the best thing about this ETF is that it has a really low management fee of 0.03%, which is actually even lower than the Australian ETFs. But the reason why this management fee is so low is because there's no hedge against the US dollar. So if you were to consider buying this ETF, then it would be best to buy it at a time when the Aussie dollar is really strong in comparison to the US dollar. And it's also the best time to sell when the Aussie dollar is weak in comparison to the US dollar. And over the last 10 years, it's delivered an average annual return of 20% per year. Out of all of the ETFs discussed so far, this one is really the best in terms of the historical performance of delivering 20% per year, whilst also at the same time having the lowest management fee. I'm certainly looking to buy some in the future as well. And the great thing about this is that they also pay quarterly dividends. Now, the next ETF, which allows you to buy US shares, is the BetaShares NDQ ETF. NDQ aims to track the overall performance of the NASDAQ 100 index. The NASDAQ 100 comprises of the top 100 non-financial companies that are listed on the NASDAQ stock exchange. And this includes all of the big US tech companies like Apple, Google, Facebook, and Tesla. So with just one trade on the ASX by buying NDQ, the ETF, you are basically investing in these companies like Apple and Google. In fact, the current asset allocation is shown here. And you can see that Apple makes up around 10% of the total value of this particular ETF, as well as Microsoft, Amazon, and Alphabet, which is Google. But the downside of this ETF is that their management fee is a lot higher than VAS and IOZ. And this is simply because it costs more to invest in overseas shares. Now, there are other ways that you can technically invest in US shares without having to pay huge amounts of brokerage fees. And one way you can do that is by using the investment brokerage platform Stake. But the problem with Stake is that there's no HIN number. And that means that there's no record held by the ASX of you owning any particular shares if Stake were to go under as a brokerage platform. And if that were to be the case, then it would be very difficult for you to recover your money. If you are though interested in what particular type of brokerage platform is the best to use in Australia, then check out my other video here. The management fee of NDQ is 0.48% per year, meaning that if you were to invest $10,000 in NDQ, you would have to pay about 48 bucks a year in management fees, which again isn't something that you technically have to pay to BetaShares. It's just something that's factored into the overall ETF price. NDQ has returned an average of 28% per year over the last 5 years. This includes the dividends that you receive from this ETF as well. What I also love about this ETF is that the dividends on this are really solid. They pay out about 3% per year. Personally, I'm a big believer in investing in these sort of tech companies that are really at the forefront of technological innovation. It's such an easy way to do that with this particular ETF. Just caution though that the price of this ETF is also determined by the US and Australian dollar foreign exchange. That means that if the price of the US dollar drops and the Aussie dollar increases, then the value of this ETF will go up. But if the value of the US dollar increases and the value of the Aussie dollar decreases, then the price of this ETF will go down. If you want to avoid the problem of this foreign exchange, then another ETF that you can buy is BetaShares NDQ, which is basically just the same as the NDQ ETF, except it's effectively hedging against the US and Aussie dollar foreign exchange. And this means that if you were to invest in HNDQ instead, then the price of that ETF isn't determined by the value of the Aussie dollar relative to the US dollar. The management fee for this ETF though is slightly high at 0.51% per annum. Now, one thing that you need to consider when investing in ETFs, and even more broadly in terms of just buying shares in the share market, is that you're also technically investing in the company where those shares originate from. The Australian Stock Exchange actually only makes up about 2% of every single share market worldwide. And that means that if you only invest in shares that are listed on the Australian Stock Exchange, then you could potentially be missing out on gains and exposure to other countries and markets. And it's typically recommended that investors do consider investing in other markets in order to diversify their portfolio. One way you can do this is by investing in the Vanguard MSCI International Shares Index, or VGS. This ETF simply seeks to track the MSCI Worldwide Share Index. The MSCI Worldwide Index is basically a representation of the top 85% of shares that are listed across 23 developed countries. It's essentially the best representation of all international share markets combined into a single ETF. That means that if you were to buy this ETF, you're not only getting exposure to Australian shares, but also other international markets as well, including the US, European, and Asian markets. Since its inception, this ETF has delivered around 15% returns on average per year and has a management fee of 0.15%, which again is about double the price if instead you were to just buy Australian ETFs. But the MSCI index is the most accurate representation of the overall performance of the share market and is therefore the best way to benchmark whether your individual investments are either overperforming or underperforming. Now, the Vanguard Total US Stock Market ETF has a price to earnings ratio of just over 24, which is slightly higher than the Vanguard International Shares ETF, which has a price to earnings ratio of just over 22. This means that you're technically paying a higher price for the earnings value if you were to go with the US shares ETF. And that's simply because the value of US shares overall are extremely high in relation to stocks in other markets. But overall though, there are so many ETFs that you can invest in, and the ones that I've talked about today just provide you with exposure to either the Australian, US, or total international share market. Whatever ETF you decide to invest in is completely up to you, but we're basically now at a point where anything that you want to invest in can be sold and bought as an ETF, including travel ETFs, ethical and sustainable ETFs, energy ETFs, and even cryptocurrency ETFs. And whilst I can't give specific financial advice, what I can say is that on paper, the Vanguard US Total Market ETF, or VTS, has been the best in terms of overall performance over the last 5 years, delivering on average 20% return per year, every year, whilst at the same time having the lowest management fee of 0.03%. You're not going to find an ETF in Australia which has any management fee that could be lower than that, whilst at the same time having historical average returns of double digits. Now, there are certainly other ETFs out there which have delivered 20, 25, or even 30% returns per year since their inception. But there's no guarantee that these ETFs will deliver a similar return in the future. If you do decide to eventually buy an ETF, you can do so by just simply logging into CommSec, searching the stock code, which I've listed in the description of this video, and simply just buy the ETF as if you were buying any other regular share. And if you need help or guidance on how to buy shares on CommSec, then you can check out my other video here in which I provide you with a detailed step-by-step guide on how to buy shares through the CommSec brokerage platform. You can also sell your ETF at any time, which means that it's essentially just the same as owning any other regular stock. Thank you so much for watching this video. Please be sure to like it and also comment below what your favorite ETF is, and please subscribe to the channel as well. Thanks for watching.